Hey, what's up, my friend? So in today's episode, right, I want to talk about how do you trade like a sniper, okay? So as you know, right, a sniper, they are people who are usually meticulous, they are slow, they are careful, and when they point at the target, right, they want, a good hit rate. Okay, it's not like machine gun where you keep firing bam, 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 right? Sniper is slow, steady, and accurate. So we want to bring those sniping personality, right, to trading. So we want to look for the best trading setups, right, that we can find. So what are the things to look for? Number one, right, you want to look for a trending market to trade with the trend. And why is that? Simple, right? Because when the market is trending, the path of least resistance is pretty clear. So let's say market is in an uptrend. If you measure the wave or the trending and the retracement move in an uptrend, you realize that the trending move, otherwise known as the stronger leg of the move in an uptrend, it's usually longer than the pullback, usually longer than the retracement move. So if you are trading with the trend, what this means, right, is that it offers you greater profit potential as the market could move further in your favor rather than taking counter trend trades. Number two, right, you want to trade from an area of value. So yes, just because the market is in an uptrend doesn't mean that you want to blindly buy, because you could be buying near the highs, you could be buying when the market is about to make a pullback, you could be buying when the market is about to make a reversal. And the problem with buying at when the market is overstretched, right, is that there's no logical place for you to set your stop loss. The nearest swing low, the nearest area of support is usually very far away, and that doesn't offer you a favorable risk to reward on your trade. So what you want to do instead is to trade from an area of value. So what is an area of value? My definition of area of value is an area where potential buying pressure could step in. So for example, it could be an area of support, right? Support is a potential area on your chart where buying pressure could step in. It could be an upward trend line. It could be a trend channel. It could be the moving average that the market has respected over the last 2-3 times. All right, so this is what I mean by area of value. So in an uptrend, right, your area of value could be an area of support, could be a respected moving average, etc. So trade from an area of value. That's number two. Next one, number three, stack area. So this is a concept, right, that it's a name I kind of come up with, right, but the concept is nothing new. So what you want to do is that you want to make sure that your area of value, let's say you are trading on a daily time frame, your area of value on a daily time frame coincides, right, with an area of value on the higher time frame, for example the weekly. So let's say your area of value on the daily time frame is an area of support, and you realize that that same area of support on your chart coincides with a weekly upward trend line. That really sweetens the deal a lot, because that area now is watched by even more traders around the world, right? Traders who trade a daily time frame as well as traders who trade the weekly time frame. So that area becomes more significant, and when it's more significant, you can expect a bigger, I would say, a larger reaction at that area. Make sense? Okay, so that's number three, stack area. Number four, you want to wait for a entry trigger, right, before you put on a trade. An entry trigger is something as simple as price rejection. So the market comes into your area of value, you want to see the price get rejected quickly at that area. So the price comes into support, for example, and then it quickly leaves support. So usually this type of price rejection or the price pattern that you see on your chart could be something like the hammer, the bullish engulfing pattern, where the market comes into support and blip, it bounce higher and quickly leave support. So this is a price rejection. This is an entry trigger, right, that you want to wait for, right, when you trade like a sniper. Okay, so these are the four concepts, right, to keep a lookout when you're trading the markets, and it would really help you improve your odds when trading. And a couple of more tips that I have for you, right, is number one. Bonus tip number one is this: if you trade the stock markets, you want to utilize this concept called relative strength, right? So what this means, right, is that you want to buy the strongest stocks out there. So here's the thing: there are like easily thousands of stocks out there in the US stock markets, and how do you define, right, what's strong and what's weak? So a very simple thing that you can use is to use this indicator called the rate of change indicator. It simply measures, right, the change in price over a given period. So let's say 50 weeks ROC, it simply measures, right, the change in price over the last 50 weeks. So you want to rank these stocks, right, according to their 50 weeks ROC, and focus, right, on buying those stocks that has the highest ROC value, because these are the stocks, right, which are the strongest, right, over the last 50 weeks, because they have moved up the most in price. And these are the strong stocks, and these are the stocks, right, that tend to continue to outperform the market. This is based on my own backtest research as well as the academic research, right, that I've studied. So really, right, if you trade stocks, focus on stocks, right, that are having the strongest momentum. Focus on stocks, right, that have, move up the most in price over the last 40 or 50 weeks. These are the stocks, right, that, you want to be focused on. Okay, so that's the first tip I have for you. Second tip I have for you is for those of you who trade FX, okay? Different forex markets, different forex pairs, right, they have different behavior. For example, if you look at the pound yen, right, this is a market, right, on a daily time frame. It has a trending behavior. What this means is that whenever pound yen breaks above the previous day high, it has a tendency, right, to continue moving in that direction. And on the other hand, a market like Aussie Canadian, right, whenever it breaks below the previous day low, it tends to reverse, right, and goes back in the opposite direction. So this again, right, is understanding the different behavior of the FX markets. And again, if you want to, trade like a sniper, and if you trade FX, it's important, right, to understand the different characteristics of different currency pairs out there, right? Because if you know a market has a trending market behavior and you're about to trade a breakout, that really puts the breakout odds in your favor, because statistically, right, let's say for example, pound yen is shown to be a trending market. If you trade a breakout or you trade a trend continuation trade, the statistics, the math, right, is already in your favor. Okay, makes sense, alright? So with that said, right, I have come to the end of today's episode. So a quick recap: number 1, trade with the trend. Number 2, trade from an area of value. Number 3, stack area. And number 4, entry trigger. This is something what I call the TASE formula. TASE, right? TASE, TASE formula. And a couple of bonus tips that I shared is number 1, relative strength. Focus on buying the strongest stocks out there. And number 2, if you trade FX, right, understand the different currency pairs behavior, right? And you can use those statistical data, right, to your advantage when you're trading certain setups. So with that said, I wish you good luck and good trading. I'll talk to you soon.